All right, the yield curve has inverted. Is this a recessionary signal like it has been traditionally, or is it a false signal this time? Let's get into it. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. All right, so the most, I don't know, reliable recessionary indicator has triggered. You guys know this. The yield curve has officially inverted, did that, 2 weeks ago. And yeah, so the 10-year minus 2-year is one of the most reliable yield curve inverted sections that people care about, parts of the yield curve that people really watch as a recessionary signal. And yeah, it inverted a couple weeks ago and kind of sort of intraday, and then it's officially inverted last week. And it inverted even more than it did prior to the coronavirus recession. So is this a recessionary signal as it has been traditionally? The yield curve has inverted. This area of the yield curve has inverted before every recession going back to 1950. So is that it? Is this just clear? Okay, yep, recession is ahead. Start buckling down. Or is it a false signal this time? You've got people on both sides of the camp. Let's get into both arguments and then draw our own conclusions. All right, first let's talk about the reasons that this is a cautionary signal. Now, this is the camp that I am in, okay? Take a look at this chart going back to the 80s, okay? You can see that the 10-year minus 2-year part of the yield curve has inverted like clockwork before every recession going back this far. And like I said, it's done that going back to 1950. Hard to argue with that evidence, okay? Now, each time is different, and yet history repeats itself, so you've got to take this hand in hand. But to me, I'm on the cautionary side, and it starts with just this evidence, okay? In addition to that, why else would I heed this as some sort of yellow flag and be cautionary about the economic waters ahead? Well, number one, we've got the Federal Reserve embarking on tight money. They're trying to tighten their monetary policy. That's a warning sign. Second, we've got interest rates that are spiking and set to increase. That's two. We've had oil prices double over a 12-month time period just recently, okay? Now, I know it's come back down a little bit, but that triggered, and that typically also precedes a recession as well, okay? And then prior to the volatility that we saw in the markets in the first quarter, we had what would be considered elevated valuations or extreme valuations at record high profit margins, by the way, in the equity market. So all of that to me suggests this could be a warning sign, and when the yield curve inverts connected with everything else, let's pay attention. Finally, on the cautionary side, I would mention, 2/3 of our economic activity in GDP is consumer-based. And while the consumer is healthy right now, take a look at a couple of these charts here talking about how the savings rate and the disposable income for consumers are off trend. They're off track at the moment due to inflation and other things. So to me, guys, I'm in the cautionary camp. I look at this, and yeah, this time might be a little bit different. We'll get into that now. But I would see the yield curve inverting, the 10 minus 2 being a cautionary sign. Now, the camp that is saying, no, this is a false signal this time, what's their argument? Number one, this is still an experiment. We have never printed $5 trillion. Never. And if there's ever a time when you could say, all right, well, this in the economy, this is a little strange to be happening right now, it would be right now. We've never printed this much money in such a short period of time, increased the monetary supply by this much over 2 years. And so you would possibly expect, or maybe at least understand, if some of the economic winds are moving in different directions or odd directions. I mean, we've seen a lot of oddities going through the economic shutdown and kind of post-pandemic era. So if you're saying, well, listen, right now we've printed $5 trillion, we're getting some weird signals right now, but rumor is half of that money hasn't even made its way into the economy yet, this is a false signal, I could understand that. I can hear you. Second, for me, it's also hard to expect a recession right around the corner when we've got so much pent-up demand. Almost everyone you talk to wants to do something with their house. They want to buy a vehicle. They want to do something, maybe even go on a trip, but they're waiting. They're waiting for supply to catch up. They're waiting for prices to come back down. They're waiting for something. There's so much pent-up demand out there. Hard to imagine we're actually going to see the economy shrink 2 consecutive quarters when so many people have their hand raised saying, I want to spend money. And speaking of that, consumers on a relative basis are pretty healthy. If you look at the metrics between debt to income and you look at the metrics for debt as a percentage of overall net worth, consumer looks pretty healthy. And so to me, even though inflation and disposable income, those sorts of things are troubling from the consumer standpoint, the consumer looks as though they've got some flexibility as well. But then lastly, and I would argue the biggest reason to not be fearful with this inverted yield curve is take a look at how the market has done the last several times the curve has inverted, okay? We see a tremendous rise up in the market in the weeks or months following, not weeks, months, following the yield curve inverting before we hit that recession, before we see that bear market. And so to me, just looking at the yield curve and having it invert is no reason to all of a sudden panic from as an investor. There's reason to still be optimistic about the markets. All right, so that's both sides. That's both camps. I've already told you where I am. I'm in the cautionary side. To me, with all of the other warning signs out there, having the yield curve invert is yet another one. Not to say, okay, there's no question this is going to happen, recession's going to hit, it's going to be a tough bear market. No, just this is more evidence that suggests be a little bit more cautionary with your expectations. And so, what should you do? Well, number one, I wouldn't gamble. I wouldn't do either one of the extremes. I did have a client call recently and say, let's move everything to cash because I'm concerned about the way things are going. That's a gamble. That's a bet, okay? That's a zero-sum game. You either win or you lose. And by the way, if you do that, you've got to be right twice. You've got to be right that you should get out right now, but then you've also got to be right as to when to get back in. It's almost impossible for people to do that, getting right twice, okay? The other gamble that I would not make is, oh no, everything is fine. There's still so much money that's trying to get worked through the system. Let's go double leverage long in the S&P 500. I wouldn't do that either. Guys, what I would do is make sure that your overall investment mix is connected to your retirement plan and your overall financial plan. Don't get things out of whack or out of balance, okay? So make sure that you're taking the right level of risk in the right accounts to achieve your long-term goals. Then second, I would just run through a quick kind of pre-recessionary checkpoint, okay? What things should you do to prepare for a recession? Well, make sure you've got the right emergency fund intact, make sure you've got the right budget and you've got margin in place, make sure you're still funding your goals, and discuss, okay, what other adjustments would we make if we fell into a recession, okay? Something like that. Work with your CFP on that. But by and large, the fact that, well, we could be heading towards a recession over the next year, 18 months, something like that, no reason to panic in your investments or investment strategy. Make sure that it's connected to your financial plan and work with your CFP to just run through a pre-recessionary sort of checklist to ensure you're not caught off guard. If you don't have a CFP on your team that can help you with that, you can contact one on my team. Find us online, Korhorn.com, that's Korhorn with a K, wisemoneyshow.com, you can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.